In June 2026, the SpaceX public offering raised $75 billion, more than double every other U.S. IPO combined. That capital raise gave SpaceX a $1.8 trillion valuation, ignoring its internal ledger, which showed a net loss of nearly $5 billion the previous year. Institutional analysts quickly labeled the valuation a bubble. Avner Staipak, chairman of Israel's largest investment firm, argued the pricing was delusional, driven more by the fear of missing out than by any sober analysis of the company's profitability. It wasn't the first time the market's enthusiasm outpaced professional warnings. When Tesla went public in 2010, Jim Cramer warned that the stock was all sizzle without any stake, urging his audience to sell immediately. Looking strictly at the balance sheet of a cash-burning aerospace firm, a $1 trillion valuation is difficult to justify using traditional economic models. To understand why the market ignored those models, we have to look past the numbers and examine the psychology of the man who built the company. Musk's perspective on risk was formed in apartheid-era South Africa, an environment characterized by systemic violence and physical hostility. In 1984, a group of classmates at Bryanston High School ambushed a 12-year-old Musk, throwing him down a concrete stairwell. He was kicked repeatedly in the head and spent a week in the hospital. When he returned home, the trauma continued. His father, Errol, sided with the attackers, berating his son for over an hour and calling him worthless. His first wife, Justine, observed that these early experiences created what she called an emotional shut-off valve. It was a survival mechanism that allowed him to compartmentalize fear, though biographers note it also limited his capacity for contentment. Biographers identify this as the origin of his demon mode, a state of cold, brutal focus where he operates with a high tolerance for instability and an apparent disregard for the emotional consequences of failure. This tolerance for instability was tested in late 2008. The global economy was collapsing, and legacy industrial giants like General Motors were facing bankruptcy. Elon Musk was facing a total wipeout. SpaceX had seen 3 consecutive rockets fail to reach orbit, and Tesla was weeks away from running out of cash. Most executives would have chosen to save one company by letting the other die, concentrating their remaining $30 million to ensure at least one survived. Musk instead split his last remaining capital between both ventures, a decision he later admitted brought him to the edge of a nervous breakdown. He was saved by a matter of hours. On Christmas Eve, Tesla closed a critical funding round, and 2 days later, SpaceX successfully reached orbit, securing a $1.6 billion contract from NASA. Surviving 2008 by such a narrow margin reinforced a specific pattern: that the most effective way to resolve a crisis was to double down where others would diversify. This comfort with the edge of ruin eventually became a weapon against institutional short sellers, investors who profit by betting that a company's stock will fall. During the production hell of the Model 3 ramp, these shorts targeted Tesla, betting that production bottlenecks would scare off creditors and force the company into a death spiral. Musk responded by orchestrating short squeezes and aggressively buying more shares. He viewed these investors not as market participants, but as existential enemies attempting to manufacture a bankruptcy. He formalized this all-or-nothing approach with his 2018 compensation package. It provided no salary, instead granting him stock only if Tesla hit a series of aggressive market capitalization targets. Wall Street lost billions because they were operating on the assumption that a CEO would prioritize stability. Musk was instead utilizing his psychological threshold for ruin to force the valuation higher. That $1.8 trillion valuation for SpaceX reflects 20 years of the market observing these survivals. After 2 decades of brinkmanship, investors began pricing in the idea that betting against Musk is a losing trade. This belief pushed SpaceX into the Mangoes era, joining Meta, Anthropic, NVIDIA, Google, and OpenAI. By integrating the xAI acquisition with the Starlink network, Musk positioned SpaceX at the center of the AI economy. The IPO was structured to keep Musk in charge. Through a dual-class share system, he retained 80% of the voting power, allowing him to use public capital while maintaining the control of a private owner. This creates a unique risk for the broader market. When investors buy SpaceX, They are buying into a belief in Musk's invincibility rather than underlying financial metrics. By anchoring such a massive valuation to one man's psychological tolerance for risk, the market has entered a vehicle with no safety nets, relying entirely on the hope that his next gamble doesn't end in a crash.